Boom, boom, bop, bam. Boom, bop, boom, 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 bop, bam.
Yeah.
The most important martial art is jujitsu. And I'll tell you why. Because to be jujitsu, you need jujitsu mixed with something else. Boxing, wrestling, taekwondo, whatever. But you gotta have. We got a target on June 27th. Another target run on June 27th.
Hey guys, good afternoon. How are you, Taylor?
Good, how are you?
Good. What you been up to? How's the dad life?
Dad life's good. I just
Yeah.
got in a load of pears and bread cows about 2 hours ago that I bought 3 days ago.
Cool. What'd you give for them? What'd you get?
I think my average was 2,100 bucks.
Spring calvers, fall calvers?
Spring calvers, peewee calves
Right.
outside.
I love it. You said calves outside?
Yeah, pears.
Wow. Okay.
Had to go a little ways, but like you said,
Yeah.
go where the drought is. So
Awesome.
just got them settled in, and so I think I'll keep my ear to the ground. It was two like dispersal herds from older gentlemen and that was South Carolina, but
Yeah.
not quite the Sandy area yet. And cows look solid. They just look like they've been run hard because they're out of grass.
Right.
So
So they're droughty down there.
yeah, we're pretty droughty too, actually. I
I
didn't really like
kind of heard that across the whole southeast.
yeah. Well, we had a pretty good drought this winter. We just
Yeah.
never got any rain. We've been getting it now, but we're behind on grass for
Yeah.
when we usually turn out.
Yeah. That's what I keep hearing down there. So interesting. Very good. How's Leah?
She's good. She's real
Good.
good.
Good. I'm glad to hear that. All right, I think Walter is here. Those of you that haven't yet, there is in the notes, in the chat, there is a file to download that we're going to use today. If you would use that, or go ahead and download that, that would be great. It'll take a second to get pulled out. Good afternoon, Olson. How are you?
I'm tired.
Oh, it's
Yeah,
nap time.
he got blown away yesterday.
Oh man, yes. I got to experience my first blown over semi. So
Oh, did you really? Ooh, I hope
Yes.
you weren't in it.
no,
Good. Were you behind it?
we were just came upon it right as it started screeching to a stop on its
Oh,
side.
yeah, that's no fun.
Well, it just is. It's life and wind, you know.
Yeah, hundreds of those every year in southern Wyoming. It's a way of life.
That's
All right. Well, let's go ahead. Walter, you ready?
I'm ready, bud.
Okay, we'll go ahead and get started. And if you have not heard yet, go ahead and download the file that's in the chat. Is everybody getting that done? Taylor, were you able to download that?
I'm working on it. It's not like in my Google accounts.
Perfect.
Yeah.
Heidi, it should be in the chat.
Yeah, I'm looking in there. I don't see it. There's somebody else that said they don't see it.
Huh. Oh, Kevin, you don't see it either, huh?
Oh yeah, sorry. I was trying to download the real-time notes. That's why it wasn't working.
no,
I don't
see it.
Walter, do you see it in there?
Wait a minute. It's in the chat. I don't see it. I don't see it either, John.
Perfect. All right. Well, let's try this again. Oh, I tried to do it ahead of time. Maybe that was too early. All right. I just put it in there again.
Yeah, it's there now.
Sent to everyone. Okay.
Yeah, it's there now.
I sent it too early. All right. I thought I could send it ahead and have it be there when you guys got in. All right. So go ahead and pull that down. It's an Excel file. It may work in Numbers or Google Sheets, but it is Excel.
All right.
Oh, there it is.
You got
Anybody
one?
not seeing it still?
I'll give everybody just a little
Give it a
bit.
minute. Yeah,
Yeah.
sure.
Okay, is that okay, John?
That's perfect. Let's we'll do a quick intro anyway. Today we are going to be talking about what has become one of two favorite topics of mine here lately, and it's kind of keeping the long-term view. And I want to make sure that we're going to start this meeting off by also encouraging, while we want to have this long-term view and understand what our long-term objectives and all are, we also want to be very much focused on the things that we are doing on a daily basis and making sure that they are getting us where we want to be. So we're gonna talk a lot long-term today, but I want to make sure that everybody leaves this with the sort of pivot in their mind that, you know, when you go outside the door tomorrow morning to do some sort of work, that it has, you know, a contributing factor to what we're going to talk about today, which is what might happen 20 years from now. So we continue to see people that are building very good businesses. And I'll just remind everyone that the beginning part of an exponential growth curve or a compound growth curve is very shallow and doesn't look like much is happening. So we want to be doing the right things and be very persistent at those things. So
That's very well said, John. That's very well said.
okay, anybody having trouble downloading that? No? Okay. Tyson, you were able to get it, I assume?
I can't get mine down.
Hey,
Oh,
if you
don't feel bad.
Wally, you're still struggling?
There ought to be a law against technology. That's just my stance today.
Hey, Abe, what's happening? Is it not downloading? Are you not seeing it? Tell me what's going on.
It's just not taking me anywhere. Like it opens up in my browser and then there's just nothing.
Try try going to Google Sheets and opening a blank document and go File Import and then select it from wherever
Try
you
that.
downloaded
Okay.
it.
Well, now
Abe, are you a
it
Google
up.
guy or an Excel guy?
What's that?
Are you a Google guy, Abe, or an Excel guy?
I don't know if I have either one of those.
Okay. So I think you can do Google Sheets just online, right? If you go to google.com and then Google Sheets. Wally, you've got Excel, correct?
Mm-hmm.
Okay. Did it work?
I've got it. I've got this green cells variables open. Change,
Yeah, that's
Right,
exactly
yeah,
right.
that's what you want.
but and stuff. So
Taylor, one thing to be very careful on yours and anybody else opening it in Google Sheets, my experience is that some things get lost going from Excel to Google, and one of them is the locked cells. So Walter has a bunch of locked cells here, so you kind of can't screw up the formulas. Those locked cells may not. You might just be careful which cells you make entries in.
Did you just tell me the secret on how to unlock all Walter spreadsheets?
That pretty much. So as far as I can tell, it's unlock all spreadsheets. The problem is sometimes you unlock it and you don't have any formulas.
Right,
But
right.
I think that seems recently to be working better.
Yeah, it's got the formulas in it still.
Okay.
Okay, all right, good. Thank you, Taylor.
But you can probably alter them, right?
Yes.
Okay.
Yeah. Okay, you ready to go, John, you think?
I think I am. Yeah. Do you want to share your screen to get us
Yeah,
started?
yeah,
Okay.
let's go ahead and start the share.
You should have permission to share.
Thank you, John.
Yep.
Can everybody see what's there?
Can now, yes.
So
Good.
not to question you, but why'd we go through all the other stuff and why didn't you just share the damn thing?
Hang on a minute, Mr. Patience. You'll
You
understand.
got to
Yeah.
realize I've been on the road for a long time.
One day on the road and you're tired, huh?
I'm grumpy.
Yeah, hang in there, Wally.
That
Hang in
doesn't
there.
take much.
Yeah. Okay, what we're gonna do today for our webinar is we're going to go through the power of growing your business with retained profits. And we've been chatting about that, over maybe the last few months, etc. And one of the things I want to go through, John, we're still going to maybe break off into about three rooms, maybe later.
Yes, I am trying to get that affected. I will let you know if we can make that work.
Okay, all right, okay. But what thought I would do is I would maybe go through an example here of what this spreadsheet is all about. So what we're really looking at is, how much in assets are you starting with, and then where do you want to end up with? So like, yeah, here we've got this is what we're starting off with, and one scenario is 50,000, and another one's 150, and we want to end up with 2 million. And then we've got different time horizons. We've got a 30, at a max at 30 in the one column, and a max at 25 in the other column. And then we're going to go back and see how we compare when we look at our return on assets. And it's so it's really pretty special with what we've been going through these last, several months on, I think, our understanding of why this all works, and what drivers make things, drive our profit, our turnover. We've chatted a lot about many things, but this is more of a culmination in the process. And there's going to be like 4 steps we're going to do. And I don't know if everybody can see sliders in this whole process, but I use sliders to maybe change my data, really quickly in the process. So there's really 4 steps that we're going to use, and what we're planning to do when we break out into the rooms is that you'll do a goal for your room, and you can start off at different levels of assets and different time frames for whatever fits your context. But what I thought I would do first is to maybe go through one and show you what the power of this spreadsheet is. So, and what we're really trying to do is take, if we're going to start with 50,000 and we're going to go for 30 years, what's the rate of return that we have to hit the 2 million? That's our process. That's what the process is and what we're trying to do. Okay. So, but let me throw out, I'm going to change this. I'm going to make a change here to show you how this is pretty flexible. So I'm going to maybe start off. We're going to be, one of the things that John and Wally and I've been talking about is sometimes we may make the investment in the wrong assets when we start our business. And maybe the bank, they push us to, I won't say push, but we go in and we think that we should buy land, and at the get-go, when maybe there's other assets that would fit our creation of wealth. Wally, you want to make you had a comment that you shared with me about that the other day.
What was that?
Well, it was the one about how close you
Oh,
wanted to be to the
oh.
working.
Well, you got to be close to the cow.
Yeah.
Yeah.
Yeah. Now
Because
explain
the
what you mean
cow-
by that.
Well, the cow or the stalker calf or the sheep or whatever you're doing is what creates the cash flow.
Right.
And the people that I work with, put animals out with people right now, is we have got they have got all this other stuff that they, you just need to own it. To be in the cow business, you only don't need to own a cow.
Right.
And other people can, you can get other people to do all the other stuff. So you just need to be aware of that. And
Right.
so
Right.
starting your business, you own cows, and then eventually if you want to be a rancher, then you can go buy your ranch,
Right. Right. So the example here, our target is we wanted to have 2 million at the end of the 30 years, and we've got $1 million worth of well, I'm going to say we're in the land space, and we've got $1 million worth of land, and we're getting a return of about 2.68. But if you actually, what it takes to get down to right at the 2 million, I'm not saying we don't want to be over it, but a minimum would be about 2.34. So I mean that's pretty consistent with a land return. Okay, and that's what it took us the 30 years. Yeah, it took us the 30 years to get there. Okay, so does everybody understand what we did there? Because when we look out 30 years and we've got $1 million asset right now, what's it take? How long is it going to take? Or what's the rate of return is it going to take for us to get to that? I mean, basically we're doubling the asset. So this is almost one of those rule of 72 deals. Okay. So, all right. So now let's go and let's say that we've got 200,000 in like what Wally's talking about with stock or cattle, etc. And remember, I think we've made the comment is, we should be able to beat the S&P in the process with what we're doing. And so let's see how long it takes us or what rate of return do we have to get to to get the 2 million when we're starting with 200. Be here real quick. We're getting closer. Whoops, we're over. Whoop. Okay. So it only takes 9.6. We didn't beat the S&P. So was that a good deal or a bad deal? What do you think, Wally?
Well, it wasn't, you know, depending on, it wasn't a bad deal, but you could have a lot better deals. I mean, why not just put your money, you know, if you had 200,000, just put it in stock market. You know?
Right. So, but let's say we got a different planning horizon. Okay. Let's cut it back to we only want to go 15 years. So let's see what it takes to get now we're going to maybe get Wally's return up there a little bit. We're getting up there past the S&P. And Ranch Right's done a lot of good work here, right? We're over the S&P by about 5.6. And we did it in 15 years, you know, in the process where and we did it on less money. And the first deal was the landed deal. Does that make sense, Wally?
Yep.
John, what's your thoughts? John still there?
Nope. John turned it over to us.
Oh,
The
okay.
guys, Walter.
Sorry, I had my microphone off. I think this is great. I think Wally's advice to stay close to the cow is good. And I think the smaller you are and the younger your business, the more you need to be focused on the rate of return.
Right.
And having a high rate of return, because we've got to get out of the blocks and get going. And what we often see with any long-term program is the moves you make early. So in a 20-year time horizon, those moves you make in the first 5 years have outsized leverage, right? Because yes, it's small dollar amounts often, but the time horizon is long, and that slow, persistent effect of time and compounding is very, very powerful.
Right. And so what we're looking at here is we only did this for 15 years. We cut the time in half and got to the 2 million on less money.
Yeah. And so then you could go buy your land, correct, Walter?
That's right. That's right.
Yeah.
Right. Yeah, that's the point, is that you could go and buy the land. And so then, I mean, if you go and if it watch these numbers right here, but if you want and you go, let's say that we do go and we go for let's say we go for 20 years, look what happened there. But our return probably went off when we went to buy when we started to buy the land, though, too.
That's correct.
Right.
Well, but this is a case where the return on land is lower, but when you have a significantly bigger investment, the dollar return still can be quite big, right? So as our asset base gets bigger and bigger, we can afford a lower rate of return because we have a lot more mass moving that thing, right?
That's right.
Yes.
Right.
And that's what a lot of people that, you know, just continue to buy land sillily like right now is they've got a land base that they can, you know, dilute the cost of the high price land right now. Correct, Walter?
Right.
That's right. Yeah.
That's right.
Yeah. So
Yeah. The other thing is these high return operations at some point become difficult to run, right? We can run a very high, you know, the smallest operations, we can run very high return, right? And we can get to a certain size with that, but there probably is a point for most of us where that breaks over into a place where now we don't necessarily need more of the very high return. We're going to keep what we have and then start pouring money into an easier to manage asset. And land is often an easier to manage asset than a herd of ewes, for, you know, flock of ewes or a herd of heifers or something like that.
right, because I mean, what we did in that And by adding that other 5 years, we added 2 million and I mean, a somewhat lesser return. So, I mean, it's really pretty powerful to actually see what this is. And then another part of this is I got a graph here. I mean, this one started with the larger, kind of the landed situation. And then this one is, you've got a higher percentage. This one, the earnings were only 50% of the growth, where this one, the earnings are 95% of the growth.
Yep.
That's a very powerful thing to notice. So, okay. So, we got any questions so far? In what we're trying to get you to get each of us to think about in this process. Any questions?
I'll add one more comment. I've done a few things recently with where we talked about that Kiyosaki ratio and talked about owning things that cash flow. And the principle is basically the same, right? Whether it's land or machinery or anything we own that is not making us money when we are small and starting out is very expensive.
Right.
And if you look at the long-term impacts of buying, for example, a $50,000 pickup truck on your business in year 1, 20 years later, that is a very, very expensive pickup.
Right. Yep.
And
So,
to me, one thing for people starting out, they got to understand that they do not need to. You can find people to run the cow for you, and I think that's a big thing. You've got to eat. You've got all you need to have your money is in cash flow generating assets.
right.
Which in our world is basically livestock, right?
Yes, is livestock. Yeah.
Right. Plus all the messaging that goes. I mean, there's a lot of positive messages for what the livestock does for the land too.
Yep.
So, because we're going to have better water cycle, there's a whole. And I know there's all this other stuff about that gets climate related, but I discount that. But that's my filter.
You're going off in the weeds there, Walter.
I know. I'll stay focused. Yeah.
All right, Walter, we're going to have to modify our plan a little bit because I don't know what's going on. I can't get these breakout rooms to happen. And I've gone back to our Zoom settings on on my Zoom account, and it says it's on, but I can't get it to, I can't get the option to show up. So is there a way can we do this individually where we set people away for a minute to do that instead of doing it in those breakout rooms?
Yeah, if we want, that would be fine too.
Okay, or we just give them scenarios and walk through them that way.
Right.
Okay.
Right. I set the target at 2 million. For your own context, if you want to set yours at 50 or you want to set it at 500, that is what you can do with the initial assets as an example. So, do you want me to?
Let's see if we could. Let's take a couple of volunteer.
Yeah, that'd be great.
I'll bet we can get a couple of those. So, can I pick on somebody?
Yeah, you pick on.
Taylor, are you able to talk?
I can talk.
Taylor can? All right, good. Taylor's got ideas. Hang on, Michaela. I'll come back. All right, so give us the target.
Give us the target? Yeah, let's go. Okay, the target, I'm going to keep it to 1 million, but I'm going to start on very small initial assets.
Okay, all right. So I'm going to do 1 million. Okay.
Okay.
All right. Now, what else?
I want to do it in 15 years.
Okay. What's your initial assets?
Oh, 50K.
50K?
Yep.
Okay. And you want to do it in 15, right?
Yep.
Okay.
And just to pick your brain, S&P is 11 about your average is what you run in your head?
Yeah, somewhere around 10. Yep.
Yeah.
I use somewhere closer to 8 most of the time.
Really?
I've used 10 in the past, but I have pulled back from that a little.
Yeah. So where we are, how much are we short? We're short $1 million. Okay. See that one, Taylor?
Yeah.
Okay. So let's look at our return.
It's gonna be 28%.
Yeah, I know.
But it's kind of fun to watch it go through.
Yeah.
Google Sheets, that we did lose the sliders if you open it in Google Sheets.
You got to type it in.
Yeah. Or use
Okay.
GoalSeek.
Yeah. You can do goal seek. Well,
Are you a GoalSeek user, Taylor?
I'm an Excel power user. That's how we raced.
Apparently. Wow. Okay. You and Michaela. I like
That's
it.
how we calculated fuel mileage on race cars, was in Excel.
Cool. Like in real time.
Yeah, like with a gun to your head.
Am I going to make the last lap or stall out?
It is. I lost Daytona that way in 2023.
No joke.
One lap
wow.
short.
Huh? What was that? What did that cost?
A lot of money.
Yeah.
Well, there we go. Yep. It's actually 22.1.
Oh, sorry. How come?
Did you came up with a different number? Did you do 950,000 on your gain there?
Oh, sorry. No, I went to 2 million, not to 1 million. That was it.
Oh,
But 1 million's easier achievable.
yeah. Okay. Yeah. So it's 22.1.
Okay.
It's interesting that only another 6% gets you to 2 million in the same time frame, huh?
Yeah.
All right.
Yeah. Those little numbers have big impacts when you multiply them across 15 years.
Right.
So I if you watch the news, if you listen to the press, it's impossible to get ahead in America anymore, right? The system is broken, blah,
yep.
blah, blah. All right. We keep not teaching people about the power of compound growth. And I feel like that is the biggest mistake we make, because I don't care if you're racist or not racist or tall or short or whatever. Like, compound growth just happens. Like I shouldn't say it just happens, but it's
well,
the law. Like, it's how the world works.
I mean, look at this, John.
Yep.
95% of this
growth.
G is the growth.
Right.
Yeah.
And I'll go back to the numbers you put in there. In 15 years is a 22% return unreasonable? Wally, what's your answer to that?
No, not reasonable.
Is it maybe rare if you look across, our industry? Sure, but not unachievable.
Well, the big thing is it's where you deploy your capital.
Right.
I agree.
That is, the secret.
I totally agree.
Right.
The more of it you've got deployed making return, the better chance you have of a higher return.
Yes, and then, like I said, you compound it, and then, oh Lordy God, it goes fast.
Yep. So again, when I have people that talk about, especially young people that ask me about what do we do with profit, which is a discussion that comes up in RFP circles periodically. If you're 25 to 50 and have the opportunity to reinvest it in your own business at a high rate of return, and I'm going to call 22 high relative to just about anything else out there, you can become very wealthy very quickly.
Right. Yep.
And turning 50,000 into $1 million in 15 years, I'm going to call quickly. That obviously requires a certain amount of patience and persistence, but that's $950,000 of growth. So it's pretty good.
Yep. So no, it's just, so, and that growth piece of the 95%, I think that goes back to a guy by the name of Ben Franklin, doesn't it?
It does indeed.
Yeah. So, yeah. So does somebody else have another scenario they want to throw out there? Or do you want to add another one, Taylor?
No, I'm good. Somebody else can go.
Let's give Michaela a shot.
I'm here.
How are you today, Michaela?
I'm great.
Good. If any of the rest of you are not aware yet, Michaela is the second newest member of our team, and we are very excited to have her. And she also,
excited to
Taylor,
be
is a
here.
bit of an Excel whiz, so. She took an Excel at night course while she was on maternity leave.
That's great.
Yeah. So is that so that you could understand the why fours of staying up late with their little one?
Exactly right.
Is it so I could understand your sliders, Walter?
Oh, Michaela. Well, oh, I tripped you that much.
I just think they're very interesting, and that developer tab led me down a rabbit hole.
Oh my goodness.
We're
Oh,
gonna have to get Michaela and Taylor together. This is good. I like it.
right.
Yeah.
Yeah.
All right.
Yeah.
So what do we want to do for a target, Michaela? I know you and your husband have some specific goals for your farm. Let's lay out an example for us here.
Well, I was curious what it would do if we take Taylor's example and just extend the time frame out.
Oh, okay. Yeah, you
Mhm.
you want to go on you want to go out to the 25?
Well, even if we could just take it in chunks and just see what big changes it makes going from 15 years with the same information. If you take it another 5 years, how much?
Okay. All
Go
right. Yeah.
15, 20, and then 25. I like that.
Yeah.
Okay. So, big picture, we're right on. It takes 16.16.
Could we change the percentage to 22.1 to match the first?
Yeah,
one?
we can. It's going to blow it away, which is good. Did you go to University of Memphis or where'd you go, sweetheart?
Martin, Tennessee.
Okay, I think I
University
did
of
know that.
Tennessee.
Yeah.
Yeah. I was just thinking if I was making 22% on my money, I'd probably enjoy working an extra 5 years. So
Okay. Okay. Yeah. Yeah.
Hey, you're at 21.2 now.
Whoops. Sorry. I'm dyslexic.
You're going up. Got to go down.
No.
Yeah. 22 point. Oh, I'm sorry. 20. Speaking of dyslexic, apparently I can't read. Sorry.
There you go. Whoops.
Off by just a skosh, but pretty close.
There you go. 1.7 extra.
Does that seem reasonable?
It's incredible.
So
Isn't
that
it
so
ama- I mean, the
so-
compounding of that's just unbelievable.
right. So again, remember I said the money that goes in early has a big impact, right? Because the extra 5 years there, the extra 5 years applies to all of that 15-year money. But of course, the first 5-year money now is in there for, 15, 16, 17, 18 years.
And looky here, John.
Yep. How much is it now? 98% is growth.
Is the growth.
Yes, Kevin, I will attach that. Are you having connection troubles?
I'm good now.
Okay, give me just a second. If
And then-
anybody else is having trouble downloading this, I'll
Well, all the problems were on my end, I'm good.
All right, you're all right.
Yeah. Now I'm going to go ahead, Michaela. I'm going to kick it up to the 25. Got it?
Okay, but write this number down. So we've got 1 million at 15 years. We've got 2.7 million at 20 years.
Right.
Let's see what 25 is.
One thing, John, I would say is everybody needs to read the slight edge because
I would agree with that, Wally. That's
This
a
is-
great recommendation.
this has, and even if it was written by Olson, but not this Olson, another Olson.
Another Olson.
Yeah.
We have recommended this book before. I think you can see it on there. This is what the book looks like by Jeff Olson, right? Hang on,
Yes.
let me get rid of
Is
mine.
that your nephew, Wally?
He wishes.
No relation. I wish.
Okay. called The Slight Edge. I'll get you an Amazon link here in just a second. But give us the thesis of this book, Wally. This book came
basically
out
it is.
long before the discussion about the English cycling team and that stuff. If you're familiar with that.
What basically what the Slight Edge is about is that little things compounded, either good or bad, or will really have growth or whatever. And like if you smoke a cigarette, it ain't no big deal. But if you smoke cigarettes for 30 years, it's a big deal. And it's just little things make a big difference, and you just got to understand it. And I thought it was a wonderful book. I need to reread it.
It is a wonderful book. I would totally agree with that. I'll stick a link here.
Now, Michaela,
Yes.
did you see what I did?
Yes.
Okay.
7.4 million.
Yeah. Well, yeah, because I kicked the first column up to the 30
Mhm.
and the 25 on the I got the same rate of return, and it's like, whoa. So, but look at the graph. 99% of it's the return.
Amazing.
Long and often, kind of like.
And we're at 19 million.
Yep.
Sorry, state of affairs.
Right.
For just another 5 years.
Right.
Yep.
Yep.
Love it.
Yeah. So, yeah,
You
because
you could probably put a down payment on a ranch if you had $19 million, huh?
yeah.
I would say unless you're really greedy, you could just go buy the ranch. Matter of fact, I know a very nice ranch. If you had it'd be good enough for me. Just
well, if you're running along at that rate, maybe
or you could buy a whole lot more cattle and really get after it,
Right. Yeah.
Yeah.
A question, John, kind of on that same line that Wally was just mentioned about buying more cows. How hard does it become to invest 19 million or anywhere along that way? Like as you start to grow, how hard is it to invest? Like let's just say that 7.3 million in a way that makes 22%.
Well, Walter and Wally, you guys can comment on this, but I would say that at that level, now it depends on prices, right? At current prices, that doesn't seem like that even would go very far with cattle, but that's always relative. But at that level, I would say that is where somebody like me is looking at real estate, because now we're sort of past our capacity to manage the livestock under our control. And this is where this sort of flywheel idea gets fascinating to me, right? Because we now have so much mass in that money that even if that money, if let's say we can invest the 7.5 million in livestock comfortably and have that continue returning for us, the additional 12 million, if we start peeling that off and only make, let's say 3% or 3.5% with that over time. Walter, what do you use as a long-term return to real estate? 2.5 to 3.5%?
Yeah, something like that, right?
Okay, but it's been on the higher end of that the last 5 to 10 years, right?
Right.
So let's say it's 3.5%. Well, heck, I would rather have 12 million making 3.5% or maybe a little more, and be able to manage it, and then grow my livestock enterprise past the point where I can manage it.
And make
Well,
that makes sense.
Yeah, another piece of that, like when you become more mature, Michaela, see, one of the things that people will try to do is they'll try to get enough capital to have a 4% withdrawal. Because if you got a 4%, that's just one number that philanthropic type folks kick around all the time. So, if you got 4% of $1 million, it's 40,000, 80,000 for two or whatever. So that's just one. I mean, and you know, and of course that's a low bar with what we're throwing out here. But that's, I mean,
Yeah,
that's
but
kind of,
what you're both getting around to is you can split that money into different risk categories,
that's
right?
right.
Correct.
So that 4%
Risk
could
and
be,
performance.
yeah, that 4% could be your living expenses and or whatever it needs to be, but you have enough capital to split into different performance categories.
That's right.
Correct.
Right. Right.
This is going to make me sound probably ridiculously greedy, but you know, really up until that 5 million point, you could stay in one category and be doing pretty darn well.
Yeah.
That is a level I think a person could manage an operations fairly comfortably without excessive, you know, organizational structure, if you
Well,
will.
no, you need to have some very good systems in there. How you're
You're gonna correct. You're gonna have some real good systems to get to that level, but I don't think it's I wouldn't call it atypical. Is that fair?
No, I'd agree with that, but
Okay.
you, like I said, you need to,
You're probably
when
not doing it all yourself.
yeah, you're not, you're not going to be doing it all yourself. Well, it depends. I mean, you know,
Yeah.
but, and also as, since I've spent the last 2 days looking at livestock that I have out with people, you know, that you've got to understand that when you give up some control, you're going to lose some return.
Yep.
Mm-hmm.
Just because of flexibility and timing and all the above.
The stuff happens category.
Yeah, this stuff happens. Yes.
Yep. Cool. Does anybody else want to try some numbers?
While nobody's talking, I'll talk. One thing you got to understand that, you know, going back to Bud Williams, you know, the livestock business is so poorly managed.
Correct.
There's great potential there. And you just need to understand that and take advantage of it. I mean, it's you know, it's me, it's a wonderful business to be in, and you you know, since I'm 73 years old and you know, running out of time and all the above, but it's still a really good business to be in. And if you're young, you need to manage it differently than I do at 73, you know. And
Totally agree.
yeah, you know, there's, you know, if you've got time is such a critical thing to understand that, oh Lordy, you know, it's just you know, where I'm running out of time as you know, it's just something you need to understand, and how you manage your business and stuff, and understand that you know, you can you know, cash flow, you know, is critical, you know, and in a falling market or in a crashing market, you can do wonderful if you're willing to keep trading, you know, and stuff.
Let me make a comment that Wally, that relates to your point. So, you know, is time, context, or mindset? What do you think, Wally?
Oh Lord, yeah. It's too late in the afternoon for me to think that deep. No, let's reconvene at 5 o'clock tomorrow morning, and we'll really have. But you know,
That's cheating.
I would agree
Make a
with you.
guess.
I would agree with you there that you know, you are correct in, you know, what you were saying there. You got to understand time and in your mind what time is and stuff.
Right, and let me make an example. Let me go with my example. There's a farmer that and this is, you know, when you deal with NRCS, say in the cover crop space, or say, you know, with some of the consultants that are out there, they'll say, well, no, just start out with a 40 or an 80. Okay, so, you know, I mean, they're making they're making an assumption, and sometimes people, when they make assumptions, you know, I think you got to watch the first three letters of that word, right?
Yes, very much so.
All right.
Be careful.
I know,
Get
I'm
us an
being not,
explicit rating here.
I know. But here's a piece I'll share with you. There's a farmer in the next county over from where I live here in Springfield, and he doesn't have the best black land. Some of it's timber, whatever. But what he did, when he's only 78 right now. Okay. But when he was 65 years old, he ordered 8,000 acres of cover crop seed. He doesn't even farm 8,000. He farmed at that point in time, he was around 4,000 is what he was doing, but he bought an air seeder and he had some custom work, and he and a neighbor were splitting the air seeder and all that. So when he ordered 8,000 acres of seed versus the 40 that you'd hear from NRCS, the distributor out in Oregon said, "What are you doing?" I mean, the guy about fell out of his chair. Nobody does that. And to reinforce Wally's point, what this friend of mine, John, said, you don't understand. You don't understand. I'm 65 years old and I'm running out of time.
Yeah.
So I mean, it all depends on how we look at time, Wally, right?
That's right. That is very correct.
Yep. Yep.
So again, is it context or is it
Mindset.
yeah?
Yeah.
Well, but it can be both.
And,
That's
and
correct.
to me, though, to me, mindset is the thing,
Right. Yeah.
And
And
I'm
I
always
think,
going around talking about it, how an old white guy's doing, but it's
well, I mean, I think, there's a whole piece too where I think that on the mindset piece is a lot of research is based off of in agriculture is based off of something that's maybe science related or whatever. Okay. And you go, whoa, wait a minute. So, yeah. Oh, but, yeah. But,
Okay, well, again, I think we never can make the point enough that we need to understand money, right?
Right.
We just like we need to understand the principles of grass growth in order to be a good grass manager. We need to understand the principles of money and how it works and how it behaves. And if I think, and Walter, you and I talked about some stuff that David Cole has put together.
Right.
I think if you are going to try to be successful in the world of finance and not know anything about money, you're probably a bit naive.
Right.
We can get away with a certain amount, but we need as business owners, as people that want to be successful, there's a certain amount we need to really understand. Now, there are things we don't need to understand, right? You don't necessarily need to understand all the details of the tax code, right? You need a person on your team that does.
It does. Right.
So I'm not saying this is you have to be a do-it-yourself on everything, but I do think there are some principles of compounding that are laws upon which many parts of the world operate, and I think we really better understand that for our own benefit.
Mm-hmm.
All right. Does anybody else want to volunteer a scenario? Or do we want to get to Walter's secret? None? Works for me.
Yeah.
Sure. You want to roll on to your secret?
Yeah. If you want, back to Taylor's comment there. If you go, I hid a row 60, and a lot of what's there to actually hit the goal. There's an equation there that or a formula that I put in there to do that, and when Taylor was talking about the goal seek, that's
yeah.
Yeah. Okay. So this one's not goal seek, but it's actually one of the few the financial formulas that's in there. But I wanted everybody to see, you know, that I'm not trying to do stubby pencil, but I wanted everybody to see, you know, kind of how this all shakes out, so you can see the buildup instead of trying to just make it on maybe 3 lines. Okay.
Yep. Does that make sense to everybody? What questions do we have? I like Brian's quote, life is like a roll of toilet paper. The closer you get to the end, the faster it goes.
Yeah. Yeah. Well, I mean, and that's the piece, you know, when you look at compound interest, I mean,
The
look,
opposite.
yeah, it's it. Yeah. 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 I mean, it's going fast.
Yeah.
Yes.
But it'll run you over when it's on the growth side, right?
Right. Right. So,
Yeah. Cool.
okay.
All right. We're a quiet crowd today. Everybody must be feeling shy.
Well, you know, well, tomorrow's the first day of spring, right, John?
It's somewhere.
Yeah.
What does row 60 tell us? I didn't understand that.
Okay. What row, if you use 10.5 in the 30-year scenario, okay, let me show you. Okay.
Good question, Kevin. While he's doing that, could anybody not get the spreadsheet downloaded from the chat?
What's that now?
Did everybody? I know you got it. Did everybody else get it downloaded? I know there were a couple of people that joined us late. Amos, were you able to get it downloaded?
We are on the iPad, so not quite.
Okay. All right. Oh, hi,
I'll
Tina.
pull it on
Hey,
the computer.
Tina, how are you?
I'm good. How are you?
I'm
Good.
good. Yeah. See here all I've got down here is the equation. Okay. In the process. Okay. So here we just
started
proved,
with a starting of 500 with 50,000 and a goal of
Right.
$1 million. You need to achieve a 10.5% return in order to get there.
on a 30-year deal.
Yep.
Okay. So that's one of the other equations.
One of the other things that's cool to me about this is that when we invest money within our small business, we have a couple of other important advantages. And the biggest one is often we can effectively, you know, if we do this with a 401k or an IRA, there is an after tax, not a 401k necessarily, but even just a regular investment account, right? We're investing after tax dollars. So let's say there's been 20% that's come off the beginning before it ever got invested, right? And that's the power of something like a traditional IRA, right? Or a 401k is that you get to invest before that tax slice happens.
Right.
And then you pay taxes on the back end.
Correct.
But in this case, we growing our business by buying business assets, except land, is a tax advantaged activity. And owning land can provide some tax advantages of its own, right? But generally, we are able to do it at a much greater efficiency because we can keep all of the money in and reinvest it if we are careful, or if not all, a significant chunk. Is that fair?
Right. Well, one of the things that John and I talked about before when we were putting this together is we were looking at what we're trying to break it down so that we can see the interim targets of where we were going, right, John? That was one of the. Okay, so I mean, big picture. Let's roll this back to 10, just so that we can see the numbers. Okay, I mean, I know this is going to be off on the goal, but just to prove my point, what we're looking at is that, come on here, I'm getting close. Okay.
One more. There you go.
Yeah. See, what we're looking at is these are all creeping up 10% a pop. So what we're really trying to do is to monitor that asset piece and see, you know, what, you know, how we come into our target. And so that's better. We needed a whatever the 10.5, but I just wanted to show you like the difference between, you know, line 16 and 17 is 10%.
Yep.
Okay.
And again, on a 30-year horizon, a 0.5% difference in the rate of return is $130,000 change.
That's correct.
That's
Right.
real cheese.
Yeah.
Okay.
Yep.
Awesome. All right. What else, Walter? Good stuff.
Yeah, I hope this, I mean, you know, like, to summarize today, I like Wally's comment about being close to the cow, close to the ewe, close to the nanny in the process, because of the farther we get away from it, you know, what Wally's saying, the turnover and the margins change. And that's the turnover and margin that's what makes this number right here, the return on assets.
Yep.
So that would be my takeaway comment.
Another thing that I see is when you get far away from the cow, you get stuff that requires maintenance. And it's a double-edged sword, in my opinion.
It is very much so, and let's emphasize that, because why is that? One, it takes money away from your ability to invest in cash flowing things, but generally anything else that you buy requires tires or oil changes or repairs, and it doesn't matter if it's a fence or a water line or a tractor. All of that stuff costs you money to own.
Yep.
And when we go back to Kiyosaki's definition of what an asset is, none of those things would fall under his definition of an asset, because they take money out of your pocket in addition to tying up capital that you could otherwise be investing.
Yeah. Another thing you need to be aware of, that work costs money. When you're doing stuff, it costs you money. So, and I'm not saying to be lazy, but understand, let the natural processes, profit from them rather than try to maximize your income. And I'm not being very clear there. I need to think this through some more.
I think you're being super clear there.
Well, no, aren't you really saying Wally is, I mean, it's like Ted Alexander's old saying is, he is a used sunshine salesman. So when you're using sunshine, which is free, I think isn't that what you're trying to maybe make the point
what
about?
I'm basically going back to my friend Walt Davis is, all ranching is rainfall, sunshine, and then management.
Right. Right.
And we've got ourselves so tied up in knots about other stuff that we just, and going back to Bud Williams, this is such a poorly managed business that it's just tremendous opportunities there.
But anybody can make a living.
Yep.
Cool. All right. Good stuff, Walter. Thank you very much. So again, I want to reinforce the point we made at the beginning. We generally are in a long-term business, right? We tend to think long-term. We tend to act long-term. I really want to make sure that the things we're doing on a regular basis are getting us to where we want to be. I think one part of that is really understanding what is possible and reorienting people to imagining what and seeing what is actually possible compared to maybe what you see just sort of on average. And just because something is average doesn't mean that's the limit of what's possible. The other thing again is this simple principle of using, compounding is very, very powerful. And I want to make sure everybody understands that when we're talking about the part we're compounding, that is the retained earnings near the bottom of your balance sheet, right?
Correct.
So we have the retained earnings when you look at your balance sheet down in the equity section, there will be a line that is retained earnings. And what's fascinating to me is to compare what the retained earnings are relative to the total equity, because in a high performing business, that will be a big gap, just like what you're showing here, Walter, of the amount contributed compared to the amount grown.
Right.
There is no better vehicle in my mind in the United States of America for building real wealth than small business.
Amen.
I don't think there's any other, you know, we can talk about Warren Buffett being an investor, all that. That's great. There is nothing that provides both the rates of return, the rate of sort of control, if you will, and then the tax advantages in one place. And especially in agriculture, because we have additional tax benefits. But even throughout all small business, whether it's a hair salon or all kinds of things, these are the places where we have been given incredible advantages. And all of the big companies that we see now, when we look at, you know, Apple, IBM, Microsoft, Amazon, Tesla, all of those, you know, sort of start as small businesses and have almost all of them have really used compounding to their advantage to get to where they are. And almost all of those companies did not exist when I graduated from high school, or if they existed, no one had heard of them. And that's what's happened in the, you know, 30 plus years since that time. So anyway, Walter, I'm super thankful that you're willing to do this. I hope you guys will play with this worksheet and use it to sort of, you know, develop an understanding of what drives these sorts of things. And if you have more questions, I know we would be happy to talk about them. So
Yeah. Yep. So anyway,
great.
well, be great. Be great, everyone.
You bet. Wally, really appreciate your comments. Thanks for chiming
John
in.
Haskell, give me a call.
I will do that.
We'll go from there.
Sounds
Idea.
great. Walter, thank you.
Be great, buddy. Thank you.
Okay, great work.
Thank you, everyone. Appreciate it.
You
Bye-bye.
bet, Kevin. Thanks for joining us. I appreciate you keeping trying.
Yeah, yes, sir.
It's a struggle today, huh?
Yes, sir.
Tina and Amos, drive carefully. All right, we'll see you later.
Bye-bye.